So we covered several of these slides already, and so I'm just going to kind of go over them briefly, not in as much detail as we did last week. So primary markets, right? That's where initial public offerings are sold. That's when a private company goes public, and they do that by registering with the Securities Exchange Commission, and they have all these requirements that they have to follow, extra requirements for like financial disclosures. That's where, all the reporting, financial reporting requirements become very, very significant. And those are done in IPOs, and you buy those in the primary markets. That's kind of where you're predominantly dealing with dealers, brokers who are working for the company itself and trying to sell the shares. And then companies can, of course, sell more shares in the future, but they do that through seasoned equity offerings. A couple of years ago, the last one I remember that I looked at was Tesla. So they actually did a seasoned equity offering. And I believe they're trying to raise more cash because at the time, people were really worried that Tesla might run out of cash. And obviously they're still here. So common stock, that's what, when we talk about buying, selling shares of stock, Apple, Tesla, Amazon, pretty much everyone's talking about common stock. There are other forms of stock in a company, but we're not going to get into them very much. And the secondary markets are where these common shares, common stock are bought and sold. And again, you go to a stockbroker, but the stockbroker, instead of selling shares for a company to you in an IPO, the stockbroker will go onto the secondary markets for you and help you buy, sell shares. And how do companies give money back to the shareholders? Because when you're a shareholder, right, you own a piece of the company. And so the way they do that is through a dividend. And that's a way of giving straight cash. And not every company does it. There's no requirement they have to do it, but it's a common way of companies to give actual dollars back into the shareholders' hands. And then when investors talk about which stocks are expensive, which are cheap, usually what they're doing is they're really commenting about the PE ratio, the price to earnings ratio for stocks. And that's probably the most popular ratio that investors use when they want to talk about, oh, this stock's really cheap, it's a really good buy. Well, it means it has a really low PE ratio. Book value we covered already, assets minus liabilities, right? Liquidation value, basically when you sell off the assets of a company and then pay off all the debts, what you're left over with is liquidation value. And then we can also recast a company's balance sheets by incorporating market value pricing on assets and liabilities. That's not easy. You probably need to have a lot of information about, the specific assets and liabilities that a company owns, and that's probably not going to be very easy to get. So now we're going to talk about the methods that we have to value stock, value companies, right? And because the issue here is that we can look up a stock. And we can look up its stock price on the market, but the stock market by itself is kind of like looking up prices for something on eBay or something, right? Let's say there's something you're really you're very knowledgeable about buying and selling, and you may not like the prices that you see on eBay for something, right? And so that's the way it is with professional investors and stocks on the stock market. Not every stock price from the market looks like a good investment to people, because sometimes a stock can be overbought, where people are so enthralled about buying and owning a stock that the price goes too high. And the reverse can also happen. Sometimes people fear so much about a stock that they drive the price down low. No one wants to own it. And then the price goes down low and low. And not always is the stock price that you see in the market a good indicator of its true inherent value over the long term. And so when we try to come up with estimates of what a company or a stock is worth, we'll usually use multiple methods for estimating what we think is the true value. And then we compare that to what the current market price is, and then decide whether or not it's a good time to invest or not invest. And so unfortunately, we don't have one method for telling you what a true value for a stock is. Different investors will come up with different estimates of the future, because that's what we're doing here, is we're trying to estimate how things will go in the future, how a company will perform. And we don't have a magic formula for doing that. And so what we typically do is we'll use 2 or 3 different methods and then kind of triangulate on what we think is a good value for a company or a stock. And if you're dealing with, the stock market in terms of whether or not you should buy or sell, that's one decision. But what if you're dealing with a private company? Then that estimate of value that you get from using different methods kind of becomes a negotiating point for you. How much do you want to pay for that company? It kind of depends on, one, the value you come up with by using different methods, but then also the negotiation process where you try to bring down the price. So it's kind of a dynamic process, and humans are at the center of it, so it's not always 100% predictable, right? And to me, I think that's what makes it kind of interesting, but it can also make it a little confusing and not always predictable. So these are some of the methods we're going to cover: book value, liquidation value, using comparables, an equation for calculating expected price and returns, and then the dividend discount model. So book value we kind of covered, right? And the assets minus liabilities. And the issue here is the historical costs that these assets are recorded at, as well as the liabilities. And so the issue, again, is it's somewhat backward looking, and it's not looking toward the future in terms of what it might be if we buy this stock and hold on to it for a few years. That being said, there are investors who use book value. It's probably becoming less and less popular as we go, especially over the last 10 years, because over the last 10 years, you see a lot of the stock returns have come from most of the companies, like we call, if you guys have heard the term FANG, F-A-N-G, Facebook, Amazon, Netflix, Google, for the last 10 years, those stocks are the ones, and now we can include Tesla a little maybe, that have really comprised the bulk of the return for the market. And so, now, and those companies are looked at as kind of expensive, but that's where most of the growth has been. But if you go back further than that, for a long time, some investors like to use the market price versus the book value. And if you've heard of Warren Buffett, he was famous when he started out. He was buying companies by looking for where the market price was less than book value. And usually they might be small companies, kind of ignored companies, and they weren't really attractive in terms of their growth prospects, but it was something that kind of started off his investing career. We can also look at liquidation value. But again, you have to have some really knowledgeable information about a company, deep knowledge about what their their assets are truly worth. And I think this was the last slide we had. And when you're looking at comparables, the thought process is like this. And let's just look at FedEx in this slide. And let's look at the rightmost 2 columns that cover price to earnings ratio. So let's assume for FedEx, the company itself has a PE ratio of 15.7. You can see right here, right? So that's calculated by taking the price of FedEx per share and dividing it by the earnings per share of FedEx. That gives you the price to earnings ratio, or PE ratio. And then directly to the right is the industry PE ratio. So they take all the companies in the same industry as FedEx. So these would be shipping companies. It would be like UPS. If there's some other companies you can think of that are similar to FedEx, they would be in there as well. And so that industry one represents the average for that industry, or the median. And so you can see right now, FedEx has a lower PE ratio than the industry. And so why would that be? There might be some bad news, something that happened to FedEx when this data was taken. It could be investors aren't feeling as good about the company. So you see that in lower PE ratios, that investors think the future growth prospects aren't as good for those companies. It could also be, if something bad happened, you as an investor might see this as a buying opportunity, because you think that whatever happened to them that was bad might be temporary. And in the long term, their PE ratio might come back up to where it was before, or at least to the median in the industry. And so you might ask yourself, okay, if currently the PE ratio for FedEx is 15.7, what would the stock price be if they were valued at the same as the industry, 18.1 PE? That's how we use these PE ratios. We try to re-estimate the value of a company using like a PE ratio for like the industry average. So let's go ahead and do that. I'm going to change my share screen to Excel. So we have here the price to earnings ratio. And if we multiply that by earnings per share, we end up with price per share. Okay. Now what we're going to do is we're going to use the industry average PE as the PE ratio, but then we're going to multiply it by the FedEx earnings per share. And what that'll do is it'll give us an estimated price for FedEx stock if the stock trades at the industry average PE ratio. And the thought process here again is that maybe there's something wrong temporarily with FedEx. I wonder what the stock price would go back up to if those problems are fixed. In this example, the FedEx PE was 15.7, industry average was 18.1. So we would just do something like 18.1, right, times by the earnings per share for FedEx. Let's just say it's 2. That would give us an estimated stock price of 36.2 for FedEx. So what's the estimated stock price for FedEx in 1 year? Well, if they fix the problems they currently have in ABC, we think they'll trade at the industry average PE ratio, which means that their stock price should go to 36.2. That's kind of how these PE ratios and comparables are used. Okay. Now, when we do come up with these valuations of companies, we can compare it to the current market price. And we know that's the market value of equity equal to the number of shares outstanding multiplied by the current stock price. And this reflects investors' expectation of what will happen in the future with this company, right? So earning power of assets. It could be based on, certain things that they own, like R&D processes, trademarks, patents, all that type of thing. Like, if a drug company came up with a wonderful vaccine for COVID-19, right? You got to think that the future prospects of that company are going to be better, and we're probably going to see a big stock price jump for that company as well. It could also mean the value of potential future investments that they haven't done yet. So a lot of things can go in the stock price from an investor standpoint, and hopefully all this stuff is baked into the stock price. People think about the future, but sometimes in the short term, what's happening in the market, what's happening to investors with how much money they have can affect their investment and pricing decisions. And so this market value of equity can sometimes diverge from kind of the true value, the long-term value of a company, purely based on how much money it will deliver to investors. They can diverge, and that's sometimes where investors see purchasing opportunities. Like, think about, after in March, when the whole COVID-19 thing really started spreading here, what happened to the stock market? It just tanked, right? But it's crazy how within a couple months, it shot back up. And it doesn't make total sense, does it, really? In terms of, did the long-term prospects for some of these companies change that much? No, it was fear and people's worrying about what was going to happen. And so that definitely affects stock prices in the short term. And so, so that was just a most recent example. Ideally, the market value of a company should be greater than liquidation value, but sometimes things do get crazy, like I said, and prices can act really strangely. Like something I was looking at today. Like real estate prices are pretty healthy right now, right? But a lot of that is consumer real estate, individual homes and stuff like that. But depending on if you look at like some commercial real estate, things where restaurants are, renting spaces, or where hotels that lost a lot of business over the last half year, you can see those prices are not performing quite as well. So usually, somewhere in the world, there's some kind of asset class group of investments that kind of are at a low, and definitely how investors view and their fear of what's happening can affect prices and make them go lower than you would think they normally should. So there's a way we can calculate the expected return on a stock, and it's based on the dividends that we'll get in the future and also the expected stock price in the future. And so that's this equation right here. So R would be either the expected return that we get, or we could also apply this to historical prices, and it could calculate the holding period return that we received on an investment. So the return is basically equal to the dividends that you get during the period plus the change in the stock price. Dividend plus the change in the stock price. Here's the change in the stock price. So the price at time 1 minus the price at time 0. So that's the ending price minus the beginning price, all divided by the beginning price. And so it's important to understand, most investors, they think about the returns they get on a stock based on a change in the price. But this equation kind of shows you there's more to it. And if you look at the historical returns of the stock market over 100 years, a very good chunk of their overall returns come from dividends, not just the change in the stock price. And if you were to look right now, at the dividend yield. And what I mean by dividend yield is that the yield, the return you get from dividends. You'll see there are a lot of stocks out there that are paying dividends that are higher than what you could get if you put your money in the bank or if you bought some type of bond. And so it is a fairly significant part of the returns you get as an investor, and it should not be discounted, especially for companies that are maybe a little bit more boring than like a Tesla or something like that. There might be companies that make consumer products like paper towels, toilet paper, diapers, Procter and Gamble type products. And a company like that could pay pretty healthy dividends, but you may not see the future growth in stock price. But remember, from an investor standpoint, does it really matter where the returns come from? So it's something to think about. Because as long as you get the returns, whether or not it's because of the dividend or because of the change in the stock price, it shouldn't really matter. Let's look at an example here. This company, Fledgling Electronics, is selling for $100 per share today and is expected to sell for $110 in 1 year. What is the expected return if the dividend 1 year from now is forecasted to be $5? All right, let's take a look at this. So we're going to use this formula right here. Right, so we need to know the dividends and then the change in the stock price. And so this is what it's going to look like. So the return, and here's the dividend. Here's the price at the end of the year. Here's the price at the beginning of the year. And here's the price at the beginning of the year as well. And so if you do the math, you should get about 15%. Now this 15% return, right, part of it came from dividends and the other part came from the change in the stock price. And so we can split those up mathematically here. So let's take this the dividend at time one and make that its own term over the initial price. And then let's take the change in the price, P1 minus P0, and similarly make that its own term over P0. And so we just split that equation up into two parts, right? This first part right here, right, that's going to be the dividend yield right here. And the second part, that's going to be the capital appreciation, how much our investment increased in value. All right, this next model is called the dividend discount model. And it's kind of our segue into the most the type of valuation models that we spend a lot of time on, because they're taking present values and they're discounting future cash flows to come up with an estimate for price. All right, and in this model, obviously it's a dividend discount model, so we're using dividends. And it's also going to use what we expect to sell the stock for at some point in the future, at the end of the time horizon that we're going to own the stock, time H for kind of time horizon. So it looks like this. So our estimate of the price of the stock, or the value, present value, is the dividend for each period discounted back to time 0. So here's the dividend at time 1, discounted back, dividend at time 2, and we keep doing that for every single dividend. And then the very last and final term, we do not only the dividend, but also the share price that we expect to sell the stock for, PH. And we take the present value of all those, that gives us an estimate of the value of the stock. So what this then comes down to, right, we need to figure out what the dividends are. And we can look at history for that. We need to figure out what we think the price will be for the company. That's not an easy one, is it? And that's where often people will use PE ratios. Like, we think this company in 5 years will be doing a lot better and trade at the industry average PE ratio. We also do some other formulas, which we're going to talk about next. The R down here, this discount rate, which you can be referred to as the investor required return or the expected return that investors expect. We're going to be given that until, for now. At the very end of the course, I'll show you how to estimate that, okay? Now, when we look at these stocks, we kind of assume that a company lasts forever, right? So that means kind of going to infinity. And that kind of like takes us back to like perpetuities, if you remember. And so the one thing we did in this model here, notice how we assumed we sold the stock for a certain price at the end. And what that does is it makes it so we don't have to forecast the dividend to infinity. Instead, we just assume, okay, let's sell the stock at the end. Then we don't have to like think about years 6, 7, 10, 20, 30, 40. Let's do an example here. XYZ companies forecasted to pay dividends of 3, 324, and 350 over the next 3 years. At the end of 3 years, you anticipate selling your stock for $94.48. What is the price of the stock given a 12% expected return? So use this formula right here and apply it to this problem. All right, let's see what we got. So this is what it would look like solving it math way. And so here's the first dividend. Here's the second dividend. And then remember, in the very final year of our discounted cash flow problem, we're going to have the final dividend plus the value of the company, okay? Or the value of selling the stock. If you remember, it's kind of like with bonds. Remember with bonds, we had the coupon payments, right? Every period. And at the end, we got the final coupon payment, plus we got the repayment of the principal or face value. It's kind of the same thing here with stocks. We get our interest income, which in this case is a dividend, right? But then we get the repayment or the selling of the company at the end, which is kind of the value or the capital appreciation, if you will. And then the 12% down in the denominator here for our discount rate, right? And so you get $75. Let's take a look at now how to solve this in Excel. So here we have the years going across the top. And this is how financial analysts typically do their spreadsheets. They'll put the year across the top like that. And then they'll list the different cash flows or expenses or revenues down the first column like this. So we had dividends of $3, $3.2, I'm sorry, 3.24, and then 3.5, right? So those are our dividends, and they're happening years 1, 2, and 3. And the stock price, where we sell the stock, right, that happens at the end in year 3, and that's going to be 94.48. Now, typically, the way we'd set up a spreadsheet is we would sum up these cash flows between dividends and the stock price that we get, right? Because those are the two things that we're getting every year. Now, I know we only get the stock price at the very end, but when you're building a spreadsheet, it's often easier to like do one formula that'll work for every single year, because then you can just copy it right across like this. Check this out. Okay. Now when I calculate the value, I'm going to put it right here. So the formula we're going to use for valuing stocks with the dividend discount model is the NPV formula. We're going to use that a lot. And the nice thing is it's pretty simple, right? So the first thing we put in is the required return or expected return, which is 12%. And then we just go ahead and do cash flow time 1, cash flow at time 2, cash flow at time 3. So it looks something like that. And I should get 75. There it is. And again, there's that's how we did it. Any questions on how to do the math or how to do it in Excel? All right, so I'm going to look at a couple special cases now. The first one is, what if we have a dividend that starts out next year at a certain amount and then it stays the same forever? How do we value that using our time value of money, discounting cash flows to the present? So the nice thing about if we get what's described in this slide as dividends that happen forever and they don't change, there's no growth, they stay the same, is it turns out to be exactly like a perpetuity. Same cash flow forever. So we can go back and we can use our perpetuity formula that we covered before. And that looks something like this, right? And you might think, you know, there's what use is that formula? Because there's no stock that'll look like that, where it has the same dividend every year into the future. Well, it turns out there kind of is. It's called preferred stock. You know, right? We talked about common stock, and that is the most common stock there is. But there is a smaller set of stock called preferred stock. And it's kind of interesting because it's somewhere in between equity and debt. It's like equity in that you get dividends, but a company can stop paying dividends if they want. And you as a preferred stock shareholder can't say anything about it really because it's equity and there's no guarantee you get dividends in the future with equity. But it's like debt because it's not going to go up. It's just the same. It's almost like a coupon payment on a bond. So it's kind of like a bond, but the company has the option of stopping it. And so why would an investor buy that? Well, because usually the interest rate you get on something like a preferred stock is higher than you can get on a bond. And also on a preferred stock, if the company ever wants to start paying dividends to common stockholders, they have to make sure that the preferred stockholders are paid back first. Long story short, there is some stock that acts like a perpetuity, and it's called preferred stock. And this is the formula how we can value it. So we use the perpetuity formula. We just need the dividend, and we need this discount rate, R, the required return. So that perpetuity, right, was assuming that dividends don't grow at all, zero growth. But what if we have dividends that will grow in the future? And what if they grow at a constant growth rate? Like, let's say we're looking at some company, like say, I don't know, PG&E. And we think that PG&E is going to grow at the exact same growth rate as the overall economy, GDP. Gross domestic product growth rate. And so let's say we assume, hey, we think PG&E is going to grow at 3% per year forever. How would we model that? So this is another special case where we have constant growth. Now we have a special formula for this. It's called the Gordon growth model. Gordon is the person who developed the model. I used to joke sometimes that's named for Gordon Gekko. And I don't know if you heard of Gordon Gekko, but there was a movie from the 80s. It was called Wall Street. And the chief, I don't know, bad person was a Wall Street person called Gordon Gekko. And anyway, I think they did another recent movie within the last 10 years or so, another Wall Street follow-on movie. The funny thing is, Gordon Gekko, the gecko is like a name of a bird that eats other birds' eggs. So that was kind of like a little, told you about the person and who they were. So anyhow, the Gordon growth model. Here it is. And some people call this a growing perpetuity. So it's a perpetuity in that it goes on forever, but it grows. And so here's the formula. Notice it's pretty close to the perpetuity formula, right? The perpetuity was the dividend divided by R, but now if you look at the denominator, it's R minus G, okay? And so if we make the denominator smaller by subtracting the growth rate, you're going to get a bigger price, right? When the denominator becomes smaller on a fraction, the overall number will get bigger. So the only key here, though, is that you can't have this go to 0 in the denominator. So G always has to be smaller. R always has to be bigger. Okay, that's the only way this works. So this is called the Gordon growth model, and it's a shortcut present value formula. So if we have a certain set of cash flows that start and they grow by G% every year, we can apply this present value formula to come up with a single value for it, right? And here it shows that the dividend always has to start one period into the future, and that'll give us a single value, in this case at time 0. Later on, you're going to see we're going to use this further out into the future, and it can give us the value of a stock at in 5 years too. Let's do an example of this. What is the value of a stock that expects to pay a $3 dividend next year and then increase the dividend at a rate of 8% per year indefinitely? Assume a 12% expected return. All right, so this is what the answer looks like. So we just take the dividend, right, that we get in the following year, $3, and then divide it by R minus G, 75. Okay, here's the next question. If a stock is selling for $100, expected return equals 12%, and the dividend will be $3. What might the market be assuming about the growth in dividends? So this kind of flips the equation around a little. Now we're going to solve for G. So go back to our equation right here, okay? And what we're going to do is we're going to plug in the information for the current price, the dividend next year, and R, and then we're going to solve for G. So go ahead and do that, please. Here's the way to solve it. So we plug in the price right here, right? Here's the dividend, $3. Here's R, 12%. And now we go ahead and solve for that G, 9%. What's good about doing it like this is you can plug in the current stock price, and from that you can kind of see what the market is implying about the future growth of this company. And that might be easier to judge too high or too low than the current stock price itself. Like if I told you if a stock was selling for $100, is that too high or too low? It's hard to tell. You can't really judge that, right? But if I say based on the current stock price, the market is expecting this company to grow at 9% per year, you might be like, wow, that seems like a lot, 9%. I just don't see how they could grow that much. So this is kind of like a way to double check the current market price to see if it might be expecting too much of the company. So what I want to do now is combine the dividend discount model and the Gordon growth model. Okay. So we had this in the dividend discount model, right? And what we assumed was that at the end of our forecasted time horizon, H, we would sell the stock for price PH. But what if we didn't want to sell it? Or we didn't want to forecast what the exact price would be at time H? If you think about it, what we could do is we could plug in the Gordon growth model instead. The only confusing thing is now, right up to now, when we've done the Gordon growth model, we came up with a value at time 0, assuming the first dividend is at time 1, right? But when we go out into the future here, we're going to have to kind of project ourselves out at the time period H and say, you know what, I want the value at time H using the Gordon growth model, which will then use the dividend that happened 1 year later. So let's see what that'll look like here. So here, I just plugged in for the price at time H up here, this whole Gordon growth model right here. Okay, and notice how it's using the dividend at time H plus 1 in one period. So this is probably one of the most common ways to value companies, by using the Gordon growth model at the very end of our forecast of cash flows or dividends. So that's the whole key here. Instead of estimating the stock price in the future, we're now going to have to estimate the growth rate in the future, this G. Okay, that'll be the key. So it changes from forecasting price to forecasting a constant growth rate. And, as long as we aren't looking at a company like Tesla or Amazon who's growing very fast, a lot of times it's pretty easy to estimate that long-term growth rate G. Because what you can do is you can look at the growth rate of the overall economy. And over long periods of time, 2 to 5% is kind of what you see. And then you're probably wondering, well, how do we do a company like Amazon or Netflix or Tesla that might be growing very fast? What they do then is we forecast out much longer time period, even 20 years, before we use that Gordon growth model, and then assume a kind of a normal economic growth rate. And because if you look at history, eventually every company slows down and starts to grow at the normal average for the whole economy. And if a company isn't really needed anymore in the economy, then they start shrinking even more. But, companies like, just name about just every single company, they used to grow really, really fast. A lot of tech companies we have now that seem like they've been around for a while, at one point, they were kind of the darlings and popular stocks of their age, and they were growing much faster than everybody else. But now we see over time, even those companies start to slow down. And it's hard to imagine, but at some point, companies like Netflix, Amazon, they're going to slow down and they're going to grow more like regular companies. So the model can be used even for high growth companies, but we just usually then forecast dividends out for a longer period of time until we think things might slow down for them. Let's do an example of this model right here, okay? Now, I'm only going to forecast out one dividend just to make the math simpler here. And then we're going to have to plug in the Gordon growth model in that first year. So let's take a look at that. What is the value of a stock that expects to pay a dividend of $3 in year one and then $3 in year two as well? And then it's going to grow at a constant growth rate of 8% per year. Assume R is 12%. Now, if you downloaded the slides before about 2 o'clock today, you'll have something different on this slide. I changed this slide's answer, again, around 2 or 3 hours ago. And so what you see now is different than what you have on the slides that you already done. I already uploaded this updated PowerPoint slide. So just keep that in mind. So the first question is, when does this constant growth start? And for us in this question, it starts in year two, right? Because we're told that starting after year two, it grows 2% per year. So that means the growth starts at year two. And that when that growth starts is when our Gordon growth model is applied. So that means the Gordon growth model will use the year two dividend. The year two dividend of $3 per share will then grow at 8% per year forever. Now the other thing, besides the Gordon growth model having that dividend at time two in it, that means that the Gordon growth model is going to be in year $1. So it's going to look something like that. All right, I'm just going to back up for a second here. Right, we started with this big model here. And basically, we only have one period in this model that we're going to use this ending part right here because we've only really forecasted 1 year dividend by itself. And the following year, what we're going to do is we're going to use that for the Gordon growth model. Okay, so this right here is what you see on the following page. So go ahead and solve that problem, please. All right, I'm going to switch to Excel to do this in. But I do want to just remember this formula right here and know that I'm going to use dividend 2 in the Gordon growth formula, but it's all divided by 1 plus r to the 1. So that means in the timeline, the Gordon growth formula is actually in year 1, okay? All right, so this is what we're given. We're given $3 dividend here and a $3 dividend here, right? Here's the question. What is the value of the stock that expects to pay a $3 dividend in the next 2 years and then increase the dividend rate at 8% per year? Okay, so then we know this is where the growth starts in year 2 and it goes at 8% per year every year. If that's where it starts, the Gordon growth model gives us a value 1 period before. And that Gordon growth model is going to be the next period's dividend, right? All divided by R minus G. R is 12% and G is 0.08%. Right, so that's going to give us a value right there. And then when we're doing our discounted cash flows, right, we add up the dividend at time 1 plus the Gordon growth model. So I'm going to say this is equal to this plus this right here, right? And so now we're going to take the present value and I'm just going to use the MPV formula because it's probably a little bit easier. I like it. And so like that. And so that's basically our solution right there. 69.64. I think we got a couple people got 69.64. Let us do this. I will tell you this. This concept of using the Gordon growth model in future years, right, and then plugging it in to represent all the future cash flows after that, all the future dividends after that, and where it goes on the timeline is probably the most confusing thing in this course. And so we're going to cover it. I'm going to do one more example today, and we're going to cover it some more next Wednesday, just to make sure we cover a lot of examples so we feel comfortable with it. But just so you know, if this is a little confusing to you, I get it, and we're just going to keep doing examples, and we'll get there. So don't fret or worry too much if this is confusing. So we're going to take some time, and we're going to visit it Wednesday, and who knows, we may visit it next week again, just so we all feel good about this. Okay. So I'm not going to cover any more slides today. I want to just do one more example. So let's go ahead, and I'm going to stay in Excel, okay? Let's say we've got, let's put together a timeline. Say it looks like this. Okay, and let's say we've got dividends forecasted to be the following. Now, normally we would not forecast dividends at time zero because it's assumed that you're looking out in the future, and we're looking at what the value of the stock is starting in time one and onward. Anything that happens at time zero, it doesn't usually enter into our stock valuation, okay? So let's say we've got dividends of 2, 2, 2, 4, 4, and I don't know, 450, okay? So here's the question. Assuming constant growth starting in year 6 of 3% per year, and R equal to 8%, estimate the value of stock. So go ahead and work on that one for a few minutes. And let's see what we come up with. All right, let's go ahead and take a look at it. So these are the dividends that we're given, right? And then constant growth starts right here in year 6. So the thing to remember is this last dividend here is going to be used in the Gordon growth model for the year before. Okay, so what that means is right here, the year before, we're going to say the next year's dividend all divided by R minus G. In this case, R is 8% and G is 3%. Okay, so that is in year $5. It's basically what it's saying. So the last dividend is only used for the Gordon growth model. That's it. We're not going to take the present value of it by itself. So that means when we go to take our present values, we don't even have to calculate total cash flows. I'll just do it like this, NPV. We know the R is 0.08. Then we go cash flow, dividend at time 1, comma, dividend at time 2, comma, dividend at time 3, comma, dividend at time 4, comma, 5. Now, remember we have to combine the last dividend plus the Gordon growth model. So it looks like that. So the key thing here is the Gordon growth model is combined with the last dividend, the next to last, I guess I should say. And the very last dividend is only used to plug into the Gordon growth model. That's it. So I got 72.07 on that one. And here's this formula. And this is this formula right here. And it looks kind of like this. So that's what that looks like. That's how we got that right there. Okay. But the key is, right, the last dividend that we're given when the constant growth starts is plugged into the Gordon growth model for the year before. And that's the key here. And then in year 5, we basically add the dividend plus the Gordon growth model. And that's going to be our final cash flow, if you will, for NPV formula. So that is it for today. Have a great rest of the week. Bye-bye, everybody.